Good morning or good afternoon, my friends. Welcome to the Traders Mindchat show. I was almost going to cancel today's episode, feeling a little bit under the weather, but you know what? Thought, let's do something. Let's push through. You guys, I love you guys, and you guys are here for value. So let's do something. And the idea that I came up with was let's have an open Q&A. So I do have a few questions that I'd like to start to share with you from the New York City IBD meetup. Well, we actually had the New York City IBD meetup earlier this week. We took in a lot of questions. We've got about 20 or so questions there. But you guys here that are tuning in live, I want your questions first. So as you have questions, go ahead, type them into the chat. Any kind of trading related question that you have, now's the time, put it into the chat. And while you're doing that, though, we'll go through the questions that came in because we did have a number of very good questions. I'm just going to share my screen with you guys, and we'll start to see some of the questions here that came in. All right, so here's some of the questions. And the question that I posed to everybody in the meetup as they were coming in was, what's your biggest challenge in trading growth stocks right now? And so if you have it, I'd like you to ponder that question too. What's your biggest challenge in trading growth stocks right now? We've got a lot of answers here, right? So these are just the first four. There's a lot of people that answered this question, but we'll go through what's here, and I want to hear your response to this too. And if you have similar thoughts of, well, what's your biggest challenge right now? I want to hear it. And also, well, what that does, it lets us know that, yeah, well, we're not the only ones that are struggling with these kinds of things. And everything that's on this list, right, from here to what we're going to see later on, I've struggled well with every single one of them at some point in my journey too. So first up here, KG says that holding a position throughout its full run higher has been a struggle for him. And you know what? That's something that's been a struggle for me as well. And it's the thing that finally changed, because I have been able to hold stocks for not the full run. Like if you're talking about catching the absolute low and selling at the absolute high, that's not what we're trying to do. What we want to try to position ourselves to do is to make profits consistently. And the way that I've been able to do that is to try to capture the bulk of the move. But even in trying to capture the bulk of the move, sometimes we can run into that problem of, oh, well, I'm not capturing enough of the move, or I'm getting shaken out, or I'm giving back too much profit. Is that you? If that's you, if you struggled with that, type into the chat. Let me know if that's something that you've struggled with. So here's how I've started to deal with holding a position throughout its full run higher, right? So what I'll do is I want to make sure that I'm entering a trade when it has the best chance to make a run, right? Because if I'm going to hold a stock and I'm going to hold it for a little while, then I want to at least get in when it's starting to make a move, right? Because if I get in today and it just goes nowhere for a month or 2 months, that's no fun. Well, we're losing time. Even if the stock stays exactly at the price that we bought it, we've lost 2 months worth of time. So we want it to be moving in the direction that we want, namely, if we're going long, going up. So how do we do that? The big way that I've learned to do that is through coming up with a model of what's going to lead to stocks that are most likely to break out and have some kind of a move. And you might be saying, well, how do you figure that out? Well, I didn't start from scratch. I started with William O'Neill's work. In fact, I've got his book right on the shelf. Excuse me one second. I'll grab it off the shelf here. Actually, grab grab a few of them off the shelf for you that I think are good. The first one here, William O'Neill's book, How to Make Money in Stocks. This is a fantastic one. And what this one does is it gives you a lot of different models to follow of stocks that have made these tremendous moves. And it shares with you all the characteristics of those stocks. And what William O'Neill found was that they tended to have extremely high earnings potential, extremely high earnings coming in before they made their big moves. And then they had potential for even more earnings down the line. Also saw that they had great sales and quarterly earnings were increasing and annual sales were increasing and all those kinds of things. That there was some sort of something new about the company, something that would change the way that we live, work, and play. There's a lot of stocks that we've seen that have come out that have had those kinds of characteristics. So that's how O'Neill would go about answering the question, well, how am I going to hold through hold a position through its full run higher? Well, we want to find the stocks that are most likely to have that kind of a move and then learn how to buy them at the right time, which is why you come up with the charts and those modeling patterns. So when I'm trying to figure out, well, how am I going to hold, right? Because it's not just buy here, sell there. There's a lot of beliefs and mindsets that go into that, right? And you could be up 20% on a stock. Are you comfortable watching all those gains go back to zero? Right? I found out the hard way that I'm not that guy. I'm not comfortable giving back those kinds of profits. But that doesn't mean that I can't profit from the market. So eventually, I found this guy, Mark Minervini, and he trades in more of a swing trading style where he's looking to sell into strength and make multiples of his risk, that he wants to turn over his portfolio fairly rapidly. So I read this book here, Think and Trade Like a Champion. He's got a number of great books, but this is my personal favorite. You can see how much I've marked that book up. And so I learned that, yeah, I could hold a position, but part of holding a position for a big chunk of its run could be selling in stages, selling into strength. Right? And so then I'm starting to figure out, well, how do I know when it's the right time to do that, right? Because sometimes you're in a market where doing that is pretty easy. Other times you're in a kind of market where it's very choppy and grindy and it goes up a little bit and then it falls right back in and then it falls back in and then it keeps on falling. So what do you do in those kinds of scenarios? Well, after reading and studying a lot of different work, I found that there's different types of market cycles and different types of market environments. And yes, Mark talks about it, and yes, O'Neill talks about it. But there's one thing to read somebody else's work, and there's another thing to study this kind of stuff yourself. And so, one of the things that I found to be so important that I actually talk about in my own book, The Trading Mind Wheel, is you need a good journaling process because when you're journaling your trades, it's not just writing your thoughts and feelings, and it's not just saying I bought here and I sold there. You're also tracking the entire move of the trade and while you're in it, how you're managing it, the different stats that are in it. And it's giving you something where if you're able to lay it out in an organized way, and one of the things that I talk about in the Trading Mind Wheel is how to do that. What you're able to do is go back in time and see, well, how did this stock how did the stock move and how did I handle it while it was in that move? How could I have handled that trade in a better way? And from your own trading, you start to figure out how you could better manage trades. And that's what I figured out. I figured out ways that I would be able to manage my trades better. One of the things that I observed in many of the trades that I was taking, and that's something else that I talk about in this book too, when you get to analysis, because analysis is important too, and studying your own trades is important because you'll start to see, well, how can I have managed this trade that's steadily rising When would it have been appropriate for me to start to exit this trade? I noticed that a lot of the trades that I'm in tend to hold the 10-day exponential moving average. A lot of them tend to hold the 21-day exponential moving average. And sometimes waiting until the 50 it could be a little bit too late. And as I'm studying the different trades and starting to see the different cycles, how they're playing out, how some of them are moving up steadily, how some of them are starting to come back in, I started to realize, wow, you know what? Sometimes it's better to hold on. Sometimes it's better to not. Well, great revelation, buddy. How do you do that? Well, part of the way that you do that is that, and this is the one of the revelations that I came to, is that the market moves in waves. Maybe that's not a huge revelation to you, but to me at the time it was. The market moving in waves, meaning that I would start to see a bulk of my trades start to make a lot of progress in altogether. And then I would go through another period of the market where it would be a little bit choppier, a little bit more grindy. So one of the stats that I started to track in my journal was what I call the high watermark of the trade. How far did the trade go while I'm in it? And by tracking that, I'm able to see, well, the trades that I'm in, that like the last 10 trades have an average high watermark of say 20%. So most of my trades are going that far. I should start taking those profits when it's getting to that level. And then in a different period, market period, oh, over the last 10 trades, my trades have basically been 5% or 10%. Well, I can't wait to 20% to take those profits because it's not getting there. So I better start taking gains more rapidly and also taking smaller risk because that's all that's there. And so that's why the one of the observations that I saw in the trading mind wheel. And so it's in really putting all this stuff together that you start to come up with an answer for how can you hold a position through its full run higher? Well, it, you might not need to even hold it for its full run. What you need to be able to do is make significant gains and to have a plan of how you're going to do that. And you don't even need to start from scratch. There's so many great books out there. Study what they did, apply it yourself, and then you'll begin to learn and figure it out. One of the big things that Jesse here was struggling with growth stocks is volatility. How many of you got shaken out and whipped around on Monday? Right? This guy did. And well, how do you deal with that volatility? One of the ways that you could deal with big market volatility is through your position sizing. How much of your capital are you going to allocate to a particular trade? That's going to save you a lot of angst. It's going to save you a lot of whipsaw. And the way that you could start to figure out, well, what's the right size to put into a trade? Should I be taking 20% of my capital and putting it into one trade? Should I be taking 10%? Should it be more? Should it be less? How do you figure that stuff out? The way that I figure it out is by looking at the market through these three lenses here: the general market, your system, and your personal performance. And by looking at it through those three lenses, I'm able to come up with an idea of, should I be stepping on the gas? Are we in a green? Or are we more in a red? Or is it kind of neutral? When the market has been hot, and sometimes the market, you'll go through phases, right? Just like how we talking about the market before, with you going through different waves and different phases of the market. This too, and there'll be certain periods throughout the year where everything's just working. The market is starting uh, to consolidate and break out and be constructive. You'll see that on the indexes. You'll see it across time frames on the indexes, and it'll align with the stocks that you're seeing setting up, the ones that you're interested in, they'll start setting up at the same time. They'll start to break out. They'll start to make significant gains, and it'll end up being reflected in your personal performance. So those are the times when it's time to step on the gas. And that will make up most of your year. At least that's been my experience. That's been the experience of actually a number of uh, market wizards, a number of champions, of U.S. investing champions. In fact, not to get too far off topic, but I did want to share with you this really nice comment that came in earlier today. Let me get this up on the screen here. Somebody that was talking about the trading mind wheel. Now, I haven't met this person yet, but I will be reaching out to him a little later on. Let's zoom in here. This guy, Christian Flanders. And so you might be saying, well, who is Christian Flanders? And I looked him up, and apparently he won second place in last year's U.S. Investing Championship, return of 433%. Here's a little bit of a better picture of him, and he had this to say about the Trading Mind Wheel. Just read the Trading Mind Wheel by Michael Lamott. Great book. I highly recommend it for traders of all skill levels. Thank you for sharing your story. Very inspiring. You never know what people have overcome in their personal lives to accomplish or what they've done. So Christian, thank you for your kind words. I appreciate them, and hopefully we could have you on the show very soon. So let's talk about volatility. Let's get back to volatility. All right. So volatility, planning for it through our three lenses here. Personal performance being a very important part of it. So if you are performing well, you want to be stepping on the gas. If you're not performing well, you want to be scaling back. It's a concept. It's a concept that I first learned in Think and Trade Like a Champion by Mark Minervini. Mark also talks about progressive exposure a bit, I believe in his first book too. Think and Trade Like, not Think and Trade Like a Champion, that's this one. Trade Like a Stock Market Wizard, there you go. Both of them, highly recommend reading those. So that's how you can deal with volatility. When things aren't working, you scale back and you trade smaller. You still take high quality trades. You're always building on the next thing. So you want to start with your pool of stocks that are most likely to do what you want. For me, I'm trading growth stocks, so I want them to have very high earnings and sales and be in top groups and all that sort of thing. Then I want to look for the patterns that are these consolidation patterns where they're showing that they're under accumulation. And not only that are they under accumulation, but they are a leader in their industry group. And I could get in with relatively small risk and potentially high reward. So that way I don't need to be right all the time. I just need to be right at least half the time. So that way the math works out. Because if I'm making two and I'm only risking one, then that's going to play out. And my stats over the years have basically been where I'm making an average of about 10 to 15% per trade, and I'm risking roughly 5% per trade. So the math works out, if I'm winning half the time or even 40% of the time. And that's right around where my numbers are. What questions do you guys have? How do you answer this question? What's your biggest challenge in trading growth stocks right now? Deepak's answer to that question was when to exit the trade. When do you exit the trade? That's something that I think a lot of people struggle with. Well, when should you exit? Because if you want to hold on for a longer part of the move, or if you don't want to give back all of your profits, how do you figure out when to exit the trade? Part of the way that I like to figure out how to exit the trade is by exiting when exiting with a substantial gain. Right? So, well, what does a substantial gain mean? I take it to mean when I've made at least twice what I've risked. So if I risk 5%, I want to take something off at about 10%. If I risked 4%, I want to start taking off something at around 8% or so, right? Well, like it's not an exact number. There'll be other things that I'm looking out too, right? So if there's, for example, let's say that there's some resistance coming up, right? In fact, let's put on let's take a look at some charts, right? It's good to talk through some of this stuff at times. So here's a trade that I'm in right now. Rubric, ticker RBRK, and I got in down here at $68.75 as it started to make this U-turn over here. And I sold a quarter of my position at $74.40 right here on this day. Now you might be saying, well, why would you sell there? Because at that point I've made about twice my risk, and we're also getting fairly close to the prior highs. And that would be a logical spot for it if price were to run into some resistance and start to pull back a bit. That would be a logical spot. So to sell a little bit as we're getting there makes sense. And so psychologically, to me, if if I'm able to nail in some gains at around that spot. I've made twice my risk. Then I could start getting my stop to break even. Then I'm a winner in the trade no matter what happens because I've locked in gains and my stop is to break even. But it's not just about how I feel psychologically. It needs to, the math about it also has to work. So that's why the 2-to-1 ratio comes into play. That's where risking 5% to make 10%, the statistics for that, if you were to work it out, and all those math equations are also in here too, spelled out in a simple way to understand. That's how all the stuff starts to come together, because it's not just about how you feel. It's not just about the math. It's not just about a single level. It's about taking all that stuff and putting it all together, and it becomes part of the process. If I had to risk 20% on this, right? Let's say that on this trade, I didn't have my stop over here at 4%, but I needed to have my stop down here at 12%, then this wouldn't be a trade that I would take. And the reason why is because if I needed to start taking profits over here, let's pull this down, right? I would be only making about 0.6 R, right? A little bit more than half what I've risked at that point. That's no good. I want to scale out when I've got about twice what I've risked at, and that's what I ended up doing. The math has to work. And so when you're starting to think about, well, when to exit, there's that's a small part of how I start to figure out how to exit. How about you guys that are here watching? I see a bunch of people watching over on X, over on YouTube. What questions do you guys have? I see the chat is pretty quiet here. It's great if you're sitting back and enjoying the show, but the way that you're really going to learn, the way that you're really going to get the most out of this is by actively engaging. So at the least, type something into the chat. Let me know that you're alive. Type that you're alive as I take this little drink here, this Magic Mind. I don't know if you guys could see it very well. It's a little shiny. Yeah, Magic Mind. Shout out to this company. They've been sending me this for free for before I wrote this book. Sending it to me every month, and it's fantastic. It's like if you ever if you ever tried 5 Hour Energy, picture 5 Hour Energy with healthy ingredients, and that's what this is. I didn't intend to plug this, but I haven't had this yet this morning. I normally drink this every day, and it tastes pretty good too. So let's see, what questions do we have? Nothing yet. I guess you guys aren't alive out there, but hopefully this gives me enough energy for all of us. All right, let's go through the last question here. There's a whole bunch more in here. People from the IBD meetup. And by the way, the New York City IBD meetup is available for free for any of you that want to join it. All you have to do is go to meetup.com, search for New York City IBD meetup, and you'll be able to find it. And so, well, we meet virtually. We're going to start to meet in person again real soon. And so, if you're in the New York City area, we'd love to see you. And if you're not in the New York City area, come to one of the virtual events. They're great. Since we're on this page here, uh, the biggest challenge, not having a consistent trading plan. Yeah, that'll do it. So, if we want to trade, well, we've got to have a plan. If you don't want to have a plan, nah, that's fine, but trading is going to be a hobby for you. And like most hobbies, you spend a lot of time and it costs you a lot of money. And if you want trading to be a hobby, then that's what it's going to be. If you want to make money with trading, but you don't have the time to dig into all the stuff. And so you guys here, you're sitting listening to me on a Friday afternoon. So I'm assuming that you really want to dig into stuff. But let's say that you're still kind of on the fence, then you could just dollar cost average into SPY or QQQ. Those are ETFs that track the major indexes, the S&P 500 and the NASDAQ, and you'll do fairly well doing that. You'll have market returns. The fees are practically zero, and you'll outperform a mutual fund. If you want to double your return over a 20-year period, all you have to do is just check in once a month, see if it's above the 12-month moving average or below the 12-month moving average. Here's the chart again. All right, so pull up SPY, and we'll take a look at this on a monthly time frame. Let's turn off the annotations over here. Right, so if it closes the month above the line, you're in. If it closes the month below the line, you're out. And so by doing this, well, we actually back tested this. I had back tested this a while ago in TrendSpider, and it was also tested by one of my friends in the New York City IBD meetup. This guy, Jay Janney, several years back. He's off. He's running his own hedge fund now. But what he had tested was that if you, over any 20-year period, if you are in when you're closing the month above the 12-month moving average and you're exiting the month when you're below the 12-month moving average, you end up doubling the return over any 20-year period. I don't know how it would do over a 5-year period, over a 10-year period, but over a 20-year period, you're outperforming and you're about doubling what you would have done just buy and hold. And the reason why is because you avoid the major bear markets. You avoid 2000, right, where the market declined 40%, almost 50%. You miss 2007, 8, 9 over here, where the market drops 50%. And so just by saying if I'm going to be long when I'm above the 12-month moving average, I'm going to be out when it's below the 12-month moving average, over any 20-year period, you end up outperforming. And there are periods where you end up getting chopped up a little bit, right? Like so over here in 2015, following those rules, you would be out right here in August, and then you would be back in October, and then you'd be out over here in January, and then you'd be back in and riding it for this whole thing right here. So there are periods where you do get a little bit of chop, but overall, over that 20-year time frame, you end up doubling your return because you miss the big drawdowns. For those of you that really want to actively trade, and you could do a lot better than this, but you've got to have a plan. You've got to have a plan. And not only have a plan, but you need to be disciplined to adhere to that plan, and also understand too that it's not going to happen overnight where you have all the skills. A lot of people come into trading thinking that they're going to be an overnight success, or that it's not that hard. I just need to put money in and know which stocks to pick, and that'll be it. Those were my beliefs when I first started out, and I had a rude awakening, just like most people do when you start to trade. You find out, wow, this is a lot harder than it looks, which is why I wrote this, because this tells you the skills that you're going to need to master in order to do well with this. So read this. It's not going to take you that long. It's about 250 pages. Here's the QR code again. It's on Amazon. Go read the Trading Mind Wheel, because then you'll at least know what you're getting yourself into and the kinds of skills that you're going to need to develop, the kinds of beliefs that you need to have, the types of questions to begin asking yourself. And then you'll be able to decide, you know what, is this for me or is this not for me? And if it is for you, you'll be able to begin developing the right kinds of skills versus what so many people do. And what I did for the first 10 years of my trading, which was basically go nowhere. So I think that's a good place to leave it off for today. So hopefully you found that helpful. If you have questions later on, please put them into the chat. I read all the questions and I do my best to answer everybody. Until next time, take care, much love, and as always, God bless.
Hey, thanks so much for sticking around to the end. If you're new here, hit the subscribe button down below and become a part of the Mara Wealth community. And make sure that you check out some of the other videos on the channel. They're exactly what you need to see. And leave a comment down below. I read all of them. Leave a comment.